Hi, Luke Fannin here from AIT. I'm looking at a capital gains tax question where you're asked to calculate the capital gains tax, the CGT, for a person for the tax year 2020. And I'm just concentrating on the sale of shares, where there is also a bonus issue and a rights issue as part of the scenario. So students can struggle with this. So hopefully this will clarify it for some people, make things easier. So we're doing this for John. John is Irish resident and domiciled, and we're just looking at this transaction. So the thing to do is, okay, read it. He sold 7,000 shares for that much. And then he has previous shares. So in 1997, he purchased 1,000 shares. And in February 2002, he purchased another 6,000 shares. And the bonus issue and the rights issue. Okay. What's important here is to know the rules for shares, and they're just here on the screen so you can pause it. So I'm not going to dwell on it, but each purchase of a share on a separate date, so that's important, on a separate date there, is treated as a separate asset. So that's important. And then the disposal of shares is deemed to arise on a first in, first out basis. So I'll go back to the question. So what that means is I have a bunch of shares, like a bunch of bananas here, from 1997. And then there was a purchase on another date on 2002. So that's a separate bunch. And I look at these as separate assets. I don't mix them up. It's really important that I don't, when I say mix them up, that I don't start calculating shares from 1997 and adding any shares in from the 2002 bunch. You keep the bunches separate always. That's important. And then the next thing is the first in, first out. So what we do is we look at each bunch in turn. So we look at bunch one and we just look and say, how are they affected by these transactions? So the first bunch is bunch one in 1997. It starts off with 1,000 shares at €2. The second bullet point has no effect on that. So you had 1,000 shares. There was a 1 for 5 bonus issue. So 1,000 shares divided by 5, an extra 200 shares. So you have 1,200 shares. Then in 2007, we sold 600. So the first in, first out basis means the first bunch of shares, the oldest bunch of shares, the ones that came in first, any sale will go out of them first. So the 600 shares in 2007 will go out of the 1997 bunch because they were first in. So 1,000 shares increased by 200 to 1,200 minus 600 is left with 600 shares and then the rights issue. And I have that down here. So you can see. So 1,000 shares, the bonus issue is here. And the thing about a bonus issue, there's no cost. So the total cost doesn't increase. And I've got a per share cost, but you don't really need that yet. The sale of shares in 600, and sometimes people, what happens is here, they forget to take out the cost. So the easiest thing to think of is with 1,000 shares at 2,000 and it's gone up now to 1,200 and there's still 2,000 cost because the bonus issue doesn't do anything, only increase the number of shares that you own. We sold 600. The easiest way to work out the cost is, so that's the cost of the shares. That's how much shares there were. So we sold 600. So 600 over 1,200 multiplied by the cost will give you 1,000. So we sold half the shares here, which means half the cost is going as well. So if we were selling a third of the shares, if we were selling 400 shares, we'd be reducing the cost by a third. So you get the proportion of shares being sold and just reduce the cost by the same proportion. So our cost has gone down now. So we have 600 shares left and 1,000, and then the rights issue comes in. 1 for 6 at 350, and there's the question there. 1 for 6 at 350. So for every 6 shares we own in 2015, we're getting 1 share, and it's going to cost us 350. So we own 600 shares. A sixth to that is 100. Now the big thing with a rights issue, like bonus issue, they just increase the number of shares. And the original cost, which is the cost from back when they're purchased back in 1997, stays the same. But the 350 enhancement, so we purchased 100 shares at 350 each. The 350 is classified as enhancement expenditure. And that will be whenever the date the rights issue took place, which was in, I forget, which was in here on April 15, which is 2015 index year, which is no index factor or index of 1. So we can summarize that and say, of that bunch, when we get to 2020, what's left of the 1,000 after adjusting for the bonus issue and the sale and the rights issue, we're left with 700 shares costing 1,000. Here they are, 700, which means the cost per share is just the cost divided by the number of shares. 1429. The index is 97.98, and the enhancement is here. We had 700 shares, and we paid 350 enhancement, which was the 100 by 350. So it's only 50 cents per share. Just watch out for the enhancement. People get confused and they start putting in the 700 shares, and they're saying it's 350 per share or something. But it's the total cost of the rights issue, which is the number of shares in the rights issue multiplied by the 350 here in this instance, and that gets divided then by the total number of shares remaining after the rights issue. So that's bunch one's cost. Then if we look at bunch two, it's a separate asset. So we start off with 6,000 shares. In 2002, the bonus issue was already done, so in 2000, so that won't affect these shares. These 600 shares were sold out of bunch one, so they're not going to affect bunch two. So the only thing that's affecting bunch two is the rights issue, because everything else was either done before or the disposal affected bunch one. So all we have to do is go adjust the 6,000 shares for 146. So we'll have 1,000 extra shares at, so the 1,000 shares will increase the number of shares to 7,000, but the cost remains the same. The cost will still be, the total cost of 48,000 will be the same, but the cost per share will decrease, and we'll have enhancement expenditure. So let's look at that here. Started off with 6,000 shares, and the total cost was 48,000. That total cost is still going to be 48,000 after the rights issue in 2015. Now the cost per share is going to reduce, and the enhancement, it was 1 for 6, so we got an extra 1,000 shares, and we paid 350 each, which was 3,500. And then if we were looking at that on a per cost basis, that's now the cost of the shares after those transactions. The total cost divided by the total number of shares. And sometimes it does help when it starts getting lots of decimals, and it does. And when you're doing shares, it does. The decimals do make a difference because you're going to be multiplying by thousands of shares. So it's good to go to a number of decimal places in this. And there's the enhancement at 50 cents. People get confused and they think it was 350. And when they sell the shares, they start multiplying them by 350 because that's what the rights issue was. But the enhancement is going to be the total of number of shares remaining divided by, the total enhancement expenditure divided by the total number of shares. So you're going to end up with something different than the cost per share of the rights issue. So that's important. People a lot of the time get confused and start multiplying. They say the enhancement is 350 per share, which it's not. So after doing that, the next thing to do is to just do the sale transaction. So come back to the question. And so we know our bunch one. So now we know we have 700 shares in bunch one. So the first in, first out basis means we're going to have 7,000 we're going to sell 700 of the bunch 1 to reduce that to nil, and then the balance will be from bunch 2. And it's important always to do 2 separate CGT calculations. So you never mix up bunches of bananas, never mix up bunches of shares or portfolios of shares. And I know bunches is kind of the wrong word, but I'm using it because it might stick in your head, particularly if you hate it. So you don't mix up, keep them separate when you're working out their cost, and then when you're doing the sale, you keep them separate as well. So because we've bunch 1 and bunch 2, when we're selling 700 from this and 6,300 from this, we have 2 separate CGT calculations, and that will make a difference, particularly when there is a loss, because sometimes the loss rules come into it where you don't use index factors because it will increase the loss. You can't use indexation factors to increase the loss. And that'll be what happened in this question, because one purchase cost is quite low and the other is quite high, which means this one probably is going to create a loss. So here's the calculation. So we sold 7,000 shares for 42,000. And this is what I mean by the first in, first out. We have bunch 1, bunch 2, 700 shares remaining, and then we have 7,000 bunch 2. We're going to sell 6,300 from there. And then here's our CGT calculation. So those 700 shares will be 700 multiplied by, and what were they sold for? We sold for 42,000 divided by 7. And that will give you, if you multiply that out, that'll give you 4,200. So you can work out the cost per share by just multiplying the total proceeds by the total number of shares, which was €6 per share. It's easy enough to work it out. And the cost then is, now you can go, but we're selling all of these. So you don't really have any working to do when you're selling all the shares. It's just going to be the total cost and the total enhancement expenditure. Because we're selling all of these shares, so it's the total cost and it's the total enhancement expenditure. So in our cost, we come down here. There's the total cost. And they were purchased in September 97. So which is 97, 98, we go to our indexation table. And the rules are down here. You can pause that if you don't know them. In 97, 98, which is September, is 1.232. So that's where we got that from. And 2015, the indexation stopped. I think, was it 2003? Yeah, so it's 1 from that point on. Getting a bit excited there. So there's our gain. The cost multiplied by the index factor and the cost multiplied by 1. Bunch 2 is 6,300 shares sold. So, 6,300 by 6 will give us 37,800. The cost then is going to be 6,300 shares multiplied by the cost per share. And you can do that by multiplying it by 6.8571 here. The easiest way to get it is, I think, if we're selling 6,300 shares, you multiply, to get the cost, you multiply the total cost divided by the total number of shares, and that gives the cost per share. So it's easier than multiplying by, it'll give you the exact figure instead of using the cost per share, because people can round it up and then they get a slightly different answer. 43,200. So the total cost was 48,000, but in proportion, if you're selling 6,300, it works out at 43,200. It's down here. So there's the cost per share, and that's how I calculate it. And then the enhancement expenditure is the same. The total enhancement expenditure was 3,500, and I can multiply that out. And it works out, I think we said it was 50 cents anyway, so, or it could be 6,300, 0.5, which is half, and that's what we worked out here. So you could use the cost per share, multiply 6,300 by this and this, or else just do it like I have done it here, where I just use the overall costs and divided them in. And when you do that and you multiply 43,200 by the index factor, I get that, and I see there's a loss. And I always in my head go, okay, indexation. So when anytime there's a loss, you have to just double check and say indexation can't increase a loss, or the other rule is indexation can't turn a gain into a loss, or vice versa. So I just have to double check it without indexation, which is here. So I'm going to come back and not use multiply by the index factor. And we still have a loss of 8,000. So if I use indexation, the loss is 10,000 because it'll make the cost bigger. But if I don't, my cost is there, 855. So the rule is do not use indexation as an increase or loss. So use the monetary loss or use the actual loss. I think I would have typed anyway, of 8550. And if we had taken away the index and it worked out a gain, you would have a monetary gain and an index loss, then you would say no gain, no loss. And they're the rules, and you'd have 0 there for that particular, for bunch 2. But here we just use the monetary loss. And then all we have to do is combine this and this, which works out at 5932 down here. You can't see it, I'll just go down. And it's a net loss. And that's what goes into your CGT calculation. And you calculate CGT on that. So that's the chargeable loss. So that loss of 5932 gets added into the other chargeable gains or losses arising from the other transactions. So here's some other transaction. There's D. C, there was margin relief. Here was a part disposal. B was testing the rules for principal price of private residence relief. And there is A wasting assets, so no CGT. And this was just checking if someone knew the rules on inheritance and the date of inheritance, and then actually no gain, no loss, I think was the ultimate result on that one, because there was an index loss, but an actual gain, a monetary gain. So the answer for part A, this one was nil. And so when you're finishing the question, I'll just show you, because a couple of people that were doing this didn't do a great job on it in the CA. You just go into all the different things, and I know for some reason I had to add both 2 A's there. I don't know how that happened, but anyway, there were 1, 2, 3, 4, 5, 6, 7 different transactions. You put in the gain or the loss, and if there's no gain, no loss, it's nil. If there's, like there is on this one, a painting, and you claim margin relief, well then, it'll be nil here. What happens is the margin relief gets added to the tax below. A lot of people got it right, but a lot of people didn't, and they put in the gain on the painting, which they shouldn't have. They just leave it nil. So you add up all the gains and take away any chargeable losses, take away your annual exemption, and this figure then gets multiplied by 33% to give you the tax. And then the 130, the margin relief to do with the painting. So by choosing margin relief, we worked out that the tax CGT was based on the proceeds minus the limit divided by 2, which is 130, and that increases the tax. A couple of people even in the exam, took it away, reduced the tax, which means they lost marks, so you increase the tax. And that's it. And more people calculated the tax and then they took that from the 97, which you don't. That's your tax. It gets increased for marginal relief, and that's what's payable. So just watch out for that. And there'll be maybe, I think, about 3 marks going for doing that CGT calculation at the end, and you should be getting all the marks there. Even if you made a mess of everything here, if you put in the figures that you got, ideally there'll be marks going for putting in nil for marginal relief. There'll be a mark going for taking away the annual exemption, a mark going for, well, half a mark for this, and maybe a mark for putting in the marginal relief and adding it to the tax. So you should do that in the exam as well, because a lot of people didn't, and they lost maybe 2.5 marks. So hopefully that's of use, and thanks for watching. Good luck in the exams.